Okay, can everybody see my screen?
Yes.
Okay, so this is an application that we've put together previously, but I just wanted to again run through Finmo with everybody so we can get a good understanding of how it works. When you create an application, it's going to ask you for your name or for your client's name, phone number, email address, and then you'll be able to send them an application link if you want to give them the chance to fill it out. I'd say for your more tech savvy borrowers, it's a good tool to use. They can fill out the application with all the information. You're just going to have to go through and validate it with the documents that they provide to you. But again, you are going to input your goal. So this borrower wants to refinance. We don't have a mortgage amount requested yet, and we'll put in our expected closing date. So let's say it's going to be July 31st. You're going to fill out all of your borrower's information. So first name, last name, email address, phone number. The account status is whether or not you have invited the borrower to create an account. In order for them to fill out the application or for them to upload documents to you, they're going to create an account. It also gives them updates as to where the file is when you do change the status of the file. So if it's an underwriting, if it's been submitted, if it's been approved, and if it's broker complete. So it'll automatically send the borrower updates where the application is. Personal details, again, it's important. Marital status, you need to make sure that you have that accurate and correct. It does show on their credit bureau. So if you put somebody as single and it shows them as married, the lender's going to have questions about that. SIN number is not required for submission, but some lenders will ask you for the SIN number if it's not already included. You can find the SIN number typically on a T1 general or the T4, or you can just ask your client for it. Date of birth, and then number of dependents. Again, this is going to be important if you are using any Canada Child Benefit or child support as income. So you want to make sure that that number is correct. Living history is important. So they need to have a full 3 years of living history included in the application. So if your borrowers moved 3 times in the last 3 years, you're going to have to include 3 addresses. It's going to ask the date that they moved in and the date that they moved out. If it's the current address, then there would be no move out date. Employment history, again, this is kind of the one where I see people are having the biggest problem, mostly in the payment type, income from the source, and income frequency. So next week, we will go over types of income again and how to calculate income. But in general, if your client is guaranteed an income on their letter of employment, you use what's based on the letter of employment. If they're hourly and don't have guaranteed hours, you can use a 2-year average. Or, if they have a salary, but they've received higher compensation for the last 2 years, you can use a 2-year average of that higher compensation. So once you've calculated the income from the source, so for her, we've put 150,000. She works hourly guaranteed hours or salaried, whichever. You want to make sure that you're
Jenna, real
inputting.
quick.
Yeah.
Does that include people that make salary and commission?
So salary, you can include it 100%. Commission, you would need to take a 2-year average of the commission because it's not guaranteed. So if your client has, say, only worked somewhere for a year and they make a $70,000 salary, but last year they made $50,000 in commission, unfortunately, you could only use the base salary of $70,000 until they have a 2-year history of the commission to use. If then they've gone on to make $70,000 salary and $50,000 commission 2 years in a row, then you could use the full $120,000 under their employment
So that
income.
50,000 of commission doesn't count until the 2 years.
Exactly. They have to have a 2-year history to get the total average of the income. If it's only 1 year, because commission is not guaranteed, it cannot be used. Make sense?
Yeah,
Again,
I'm
okay,
good. Yeah.
perfect. Again, this is where I'm seeing the biggest issue. If you are putting in that your client makes $150,000, you want to make sure that you are not putting the income frequency as weekly, bi-weekly, semi-monthly. If you calculate their monthly income as $10,000, then you can go in and put monthly here. But if you have their total annual income, which is the most common way to calculate income, you have to make sure that you have it inputted annually. Okay. Again, for employment history, you must have a 3-year employment history. So if you put that somebody's worked there for 3 years and then their letter of employment confirms that they've only been there for 1 year, the lender is likely to come back and to ask you for the additional 2 years of employment history if it's not already included in the application. Other income, again, other income is not to be used for any type of employment income or self-employment income. Employment and self-employment are always going to be included under the current employment section. Other income is going to include pension, CPP, OAS, child support, spousal support, Canada Child Benefit, survivor pension benefit, that sort of thing. Again, you're going to put in the annual income and select annual. So say we can look at the CCB one that we did. She receives $4,200 annually for her CCB income. When you are qualifying with Canada Child Benefit, you have to remember that you will require birth certificates for children. The majority of the time, you can only use Canada Child Benefit if the child is under the age of 12. That's because they want to ensure that you're going to have that full amount of Canada Child Benefit for the whole term of the mortgage. B lenders, sometimes you can get an exception to that because the terms are typically shorter. So if the child is, 12, 13, 14, they're more likely to let you use it. Again, it's always good if you're going to qualify using the Canada Child Benefit income that you confirm the ages of the children. Assets, again, is a good way to strengthen an application that may not be super strong on its own. So if your GDS or TDS are a little bit high or the credit's a little bit low, if you can show that the client, has a good history of saving money, they have good assets, it can definitely help improve your application. There are net worth programs out there for clients with higher net worth that maybe wouldn't necessarily qualify on the traditional side, but would because they have that high net worth that, is equal to or above the amount of the mortgage that you're asking for. That is always a good way to, to try and qualify an application that may not otherwise work.
Photo edit chal. This is fine, at least photo.
For liabilities, all of this is going to be automatically pulled from their credit bureau. The only information required to pull the credit bureau is going to be that name, birthday, and address. As long as you have that information, you can pull the credit bureau. Obviously, I haven't pulled one for Jane Doe here because she is not a real person, but I've just gone ahead and inputted a liability here. Again, when you're looking at revolving debt like credit cards, personal lines of credit, you need to take 3% of the outstanding balance, not the payment reported on the credit bureau. It's 3% of the outstanding balance to calculate the monthly payment. Finmo should do that automatically for you, so that you don't have to calculate it yourself, but it's always good to just double check. This section here is where you can determine whether it's going to be paid off or not. So we are refinancing this mortgage and paying out this debt. So we're going to put to be paid out from proceeds. If you are trying to qualify, say, a purchase, and we know that the client plans on paying the debts out prior to the mortgage closing, you would mark that as paid prior to advance. Advance meaning the advance of the mortgage, the closing of the mortgage. So we can pay this debt out from the proceeds of the loan. So this is what we have put in as her current property. This is a rental property here. We've put in the monthly rental income at $4,500. We've included all of her mortgage information here. It's important that you have the payment amount correct. This will be pulled from the credit bureau, so you want to make sure that you have the correct payment and then it matches up to what's reporting on the credit bureau, as well as the balance, especially if it's going to be the one that you are paying off. This is the loan that we're paying off, so we've marked this one to be paid from proceeds. Again, it's a refinance, so we'd be paying out that $200,000 from the proceeds of the refinance. And then this is her owner-occupied property here. Okay. I'm not sure why we have this in twice. I don't remember what we were doing on this application previously, but the subject property is the property that you are mortgaging. So you want to ensure that you have all of your information here inputted correctly. So pretty much all of this needs to be filled out. You would only input this information here, lot, block, and township, if, say, this is a new build property that doesn't have an assigned address yet. So you want to go in and select your construction type, the type of home that it is. Obviously, a freehold is a single detached home. Condo is going to be a condominium, so we'll put this as a freehold home. I've gone over this before, but it's important to give as much accurate information as possible. Some lenders can value the property based on an automatic valuation model, or a desktop appraisal that they can do themselves, as long as you provide accurate information through Finmo. So that could save your client a few $100s, and not have to get a full appraisal done, send somebody into their office. So we'll say that's a 1 unit, a 2-story home, and we're 15 years old. So all of this information may save your client from having to pay from an appraisal. Most of the time, especially in today's market, they're probably going to want a full appraisal regardless, but it is good to just submit with the correct information anyway. Annual taxes, you want to ensure that you have the correct property taxes inputted here. Right now, most clients have their 2024 interim tax bill. Some lenders may still accept the 2023 final, but for the most part, you would want to collect the 2024 interim tax bill. This ensures that your client has been paying the property taxes. Property taxes do have to be paid as agreed upon, up to date with A lenders. A lenders will not pay out property tax arrears, even if your file is in perfect, your GDS and TDS are in line, you've got great credit, solid income, good property. If you have property tax arrears, you're not going to get those paid out by the lender. So that's automatically pushes you to the B side. They're also going to want to know why those property taxes haven't been paid out, what's caused that. So it is important to ensure that your client is up to date on their property taxes. You can select whether they're paid by the borrower or the lender. So we can see that the borrower pays these. If there are condo fees, you must disclose them. So that's something to keep in mind as well if you're working on a pre-approval for a client. If all of a sudden they decide that they want to buy a condo and you haven't included condo fees in your numbers when you're qualifying the client, that could add anywhere from $200 to $600 a month into their property expenses, and that could definitely push their debt service ratios out of what they could qualify for. Condo fees are almost always included at 50%. So if you do have a $600 condo fee, they're only going to include half of those condo fees in your GDS and TDS calculations. Heating expenses are almost always $100 per month. If it's an exceptionally large or an exceptionally small property, that can fluctuate, but for standard, I just always go with $100 a month. And then everything else you can pretty much leave blank here. You don't need to include insurance, management, repairs. This sort of thing only comes into play if you have multiple rental properties, at which point the lender would ask you to fill out a rental worksheet, where you're going to have to find the insurance expenses, management, repairs, all of that expenses per month. And then they do another calculation that decides whether or not the debt service coverage is within their guidelines. That's a whole other thing that we can go over when we do training that's specific to rental properties, but something to keep in mind. So you can put in an estimated value or you can put in an appraised value. Typically when you're working on A and B files, I find that it's very rare your client is going to have an appraisal up front or you have an appraisal up front. You can ask your client what the estimated value is. You can ask a realtor what the estimated value is, or you can check House Sigma. That's a program that we've reviewed recently that allows you to just type in the address and get a general estimate. You can also pull a purview. I find purview typically gives you a lower value. So I would either chat with a realtor, look at, comps yourself if you can find it in the area, or look at House Sigma and just get an estimated value so that you know what you're working off of. If you do an appraisal, you can punch in the appraised value and the appraisal date. It is important to know what the original purchase date was, especially for a refinance. These days, the lender's going to want to know if they bought this property at the height of the pandemic when prices were really crazy, 2020, 2021. And you're trying to say that the value is higher or even equal. A lot of the time they're going to come back and say, well, if they bought this property for $1 million in 2021, it's probably only worth $850,000 now. So it is good to include. Or if your client bought this property for, say, $500,000 10 years ago, and you are keeping the value, within a reasonable range, say you've only put the value up to $600,000, they may not even require an appraisal. Again, they may be able to use their desktop appraisal for that. So again, we want to make sure that the remaining balance is to be paid from the proceeds of the sale, and not the sale, of the refinance, and save those changes there. So this is where, again, I'm finding people are running into problems. They're saying that they filled out the whole application and they have no GDS and TDS. So there's something wrong. People aren't actually filling out the mortgage request details. So that is, that's very important to do. That's how your GDS and TDS are going to be calculated, as well as we're going to find out what the final loan to value is. So we've put this property value in at 900,000. She currently owes 200,000 on it. So let's say she wants to do a $200,000 equity takeout. So we're going to request $400,000. Knowing that we have a client who has, say, a 750 credit score, and she has guaranteed income, she makes $150,000 a year. Knowing 2 out of 3 factors, we don't know the GDS and TDS yet, I'm going to assume that this is going to go to an A lender just based on the guaranteed income and the good credit score. So I'm just going to go in with a 5% interest rate, just to see where our GDS and TDS land. When you put in your interest rate, it's automatically going to update your qualifying details to either 5.25 or contract rate +2, the greater of either. Everybody should know what the stress test is, what the qualifying rate is. I hope they're still teaching that in the REMIT course or the CMP course, whichever one you took. The qualifying rate is going to be 5.25 or contract rate +2. Right now, the greater of the two is contract rate +2. We've inputted 5% as our interest rate. So our qualifying rate is going to be 7%. It should automatically update that for you. We're going to do fixed first mortgage. Compounding period is going to be semi-annually. That's the most common. Pretty much only private mortgages compound monthly. It's going to be amortized. Again, pretty much only private mortgages are interest only. And let's just say we're going to do a 5-year term, though that's not going to be most likely. Right now, people are typically going for 2 to 3 year terms. Payment frequency monthly, payment term is going to be closed. So we are going to save our changes here. You can see this is where your GDS and TDS calculation is pulled from. So if you ever wanted to run those numbers yourself, if you didn't believe what the computer was telling you, it gives you all of your income and expenses to calculate your GDS and TDS. Does everybody remember what GDS and TDS are and how to calculate those? Can anybody tell me?
மறந்து போச்சு 44 or 46.
Okay. GDS is your gross debt service ratio. TDS is your total debt service ratio. Does anybody remember the calculation?
I think it's the PIF, the principal, the interest, your taxes, and then the heating.
No,
Yeah.
And then plus the other debts that you have to pay. So like a car loan or things like that. but not insurance.
Oh,
And then divided by how much income you have.
Could somebody, I'm not sure who it is that's not on mute, if they could just mute themselves. Perfect. Okay, yes, you are correct. So TDS, your total debt service ratio, is your PIF plus liabilities divided by your gross monthly income. Your GDS, which is your gross debt service ratio, is just PIF divided by your gross monthly income. So gross debt service ratio is just including the housing expenses. So that's going to be, let's see, property fences. Okay, yeah. So that's going to be your mortgage payment, taxes, interest, heating. That's why we include that $100 monthly heating fee divided by the gross monthly income. And then your total debt service ratio is including your additional expenses. So your car loans, your credit cards, your personal loans, that sort of thing. So you are correct. So as you can see, our GDS and our TDS up here are 6% and 34%. Does anybody remember what the maximum GDS and TDS for the A side is traditionally? I know somebody's got to know this.
It's usually, can I, sorry.
Yes, go ahead.
Usually it's like around 38, 39 for GDS and 42 to 44 on TDS, depending on if it's a traditional or if it's like what is it?
Insured.
Sorry, insured. Yeah, mortgage.
Yeah.
Insured is a little bit higher, right?
So yes, it's typically we want to stick within 39 to 44. That's the absolute maximum for insured deals. It was a little bit lower for COVID, and then everybody came back up to 39 and 44 during COVID, so that people could qualify a little bit easier. Conventional deals, you have a little bit more wiggle room. Sometimes you could get away with like 39 and 45, 39, 46. Again, it all depends on the lender, depends on if they have an existing relationship with the bank, but in general, a deal is going to be 39 and 44. If we were, say, 40 and 47 or 41 and 47, we could probably go to a B lender. They're typically will go up to 50, maybe 55, maybe 60 TDS. Home Trust, I don't know if any of you guys sat in on that presentation. Typically we'll go up to 60% TDS. I've been able to get them to go up to 67% TDS before, but again, there was a client with a strong net worth, good credit, and very high stated income. So again, having a good relationship with your lenders, knowing your lender policies, getting in with a good underwriter with that lender could be very important for getting your client approved. And also just knowing, being familiar with the lender policies. If you know that your client has an existing relationship with TD, they've got TD credit cards, they've had a TD mortgage, TD may be more likely to approve your client when they're at, say, a 40 GDS and a 44 TDS than anybody else. So generally 39 to 44 on the A side, and then up to 55 on the B side, certain lenders up to 60. But we can see our client here definitely qualifies for an A mortgage. So there's two ways that you can look at lender spotlight in this instance. One would be if you were go to submit. You can see this as the lender spotlight, and we can go to find available products here. Then it is going to input everything that we've already selected. So we're in Ontario, we're refinancing. Our mortgage amount's 400,000, our amortization's 30 years, property value, it calculates the loan to value for you. It inputs the GDS and the TDS. And then if we know our client wants a 5-year, we can go ahead and select a 5-year too. So it's going to pull up all of this information for us. We know the lenders that we use most frequently, say TD, Scotiabank, First National, and we can decide which one is best for our client. So let's take a look at the First National rate. So First National has on a 5-year fixed conventional uninsurable special. So that's a good deal. That's 5.19. We could say Scotiabank has 5.29 on. This would be based on. There we go. Okay, so standard bundled pricing. It's important to remember that Scotiabank bundled pricing means that they have to have 2 products with Scotiabank outside the mortgage. So that would be like a bank account, a credit card, and the mortgage. They get the bundled pricing. If they don't have those or they don't want to sign up for those, then they are going to get 5.44. It looks like would be the standard non-bundled pricing. And then we can also look at who else? Now let's see what Manulife has to offer. So Manulife won preferred pricing. I don't know if we have access to preferred pricing, but the standard pricing will be 5.44. So I'm going to say that we would select First National as our best bet. We would go First National for the conventional uninsurable special, as long as this isn't a we'd want to review the terms for this rate. We want to make sure that we're not putting them into a no frills offer that locks them in for 5 years. If they, end up wanting to refinance, or if they end up wanting to sell, we want to make sure that there's not going to be a big penalty for them to pay that out, or just to make sure that they would be able to pay it out. So a lot of the time when you get a really, really low rate with certain lenders, it comes with what's called a no frills mortgage, or it's a mortgage where your client gets locked into that for the full term unless they sell the property. So no refinancing, no switching, nothing during the term. So it is important to, again, understand, is your client going to keep this property for the term? Do they plan on selling at any time? Do you think they're going to refinance again at some point? So again, back to that, having that full conversation with your client in the beginning to make sure that you understand all their needs. If you have a client who you've just had that general conversation with, and you know that they want to refinance their property, and you want to try and give them a quote for a rate, you know that they're refinancing, you know that they want a 5-year fixed, you know that they have good credit, so we could go in and punch in the Beacon score at 750. Maybe you don't know what their GDS and TDS is yet because you haven't run the numbers. You know their property value is 900,000. And you know that they want as their new mortgage $400,000. So you can always go in and punch all this in manually before you even have that conversation with the client. And I can show you how to do the comparison. So we'll go back to First National. We can add this guy. So we'll select the conventional uninsurable here. We're going to pick our Scotiabank rate. So we're going to go standard bundled, and then we can select, say, Strive. So if your client wants to see what their options are for lenders, we can do the comparison. Here we go, compare products. So now we can create something that we can send to the clients, a report that shows all of the terms. So we can see everything's a 5-year fixed, up to 80% loan to value. We can see what the Beacon range is. This is really good for our uses as well. If you're just looking to compare some products to make sure that your client does qualify, it has all of your prepayment options, down payment, rental policies, types of income, ports and switches, and then we can go and generate the report for your client. You can decide what's going to be included on here. So if you don't think your client needs to know what the loan to value is, what the maximum amortization is, you can include your compensation and your buy down on here if you want to know about that. So you can actually have it so that it removes the lender as well. So if you're just trying to show them 3 rates and you know that they're shopping around, you can decide that you don't want to show them who the lender is, so they can't take that to another broker and shop it. If they don't need to know what the Beacon range is, they don't need to know what the transaction type is, but we want to show them what the prepayment options are. We want to show them what the prepayment penalties are, and they want to know if they're able to port the mortgage. So we can go in and create that report for them. So your name's going to be on here. We're going to have 3 different products on here that they see. It's removed the lender name again. So if you don't want them going to shop, it gives you just the general overview here. And then on each page, it's going to go into each option. So we wanted to include what the rate was. We wanted to include the term. We wanted to include the rate hold, as well as they wanted to know what their prepayment options were, prepayment penalties, and what the port policy was. So it's going to do this for every single one that we've selected. I think you can do up to 4, and you can save this and send that to your client as a report if they're the type that's very analytical and likes to look at their options. Okay, that's what we're going to go over for Finmo again today. Are there any questions at this point?
Hey Jenna, have you tried that AI thing on the lender spotlight and see if it automatically gives you the best result?
I have not. I think you have to pay for it, so I haven't tried it.
Okay.
From my understanding. Yeah, I think it's like an additional subscription that you have to pay for. Let's see. Oh, okay, maybe not. I guess I lied. I have not tried it, but it may not be. Hmm. Oh yeah, okay. So you do have to purchase the add-on to fully enable your AI assistant. I think that, AI can be useful in some circumstances, but it's really important for you to learn the policies yourself, because you're not going to have an AI assistant when you're on the phone with the client. That's when you're going to be building the biggest rapport. I think it's good to have the knowledge in your own right and use AI where it can be used. But I suggest that you avoid using those tools while you're learning so that you can get the best understanding of the way that things work. So you can be competent when answering questions to your client, selling to your client, and, so that they understand that you know what you're talking about.
Yeah, totally agree.
Any other questions at this point, guys? Okay, so I wanted to kind of move back into how to select your lender again. So at this point, does everybody have a good understanding of the difference between A lenders, B lenders, and private lenders? This is something that we've gone over, so I just want to make sure that I'm not spilling the same information at you guys over and over again. Does anybody want me to review this again, or do we have a good understanding of where we're at with A, B, and private lenders?
I'm good.
Okay, I will take that as everybody's good then. Again, just an example of the different types of A, B, and private lenders here. This is the biggest thing when it comes to evaluating the application, is looking at the income, the credit, and the property type. This is how you're going to decide where your application ends up, if it's going to be A, B, or private. Sorry, there was a question that I missed earlier. What is the home value range where lenders could do an AVM for Ontario through Finmo, and when would full appraisal be required? I would say 85% of the time a full appraisal is required. You could typically do an AVM on a property that you've either undervalued. So the lender thinks that, if they, like I said, if they bought it 10 years ago for 500,000 and you're only putting the value at 600,000, that may be a time where AVM is included. If it's a newly purchased property, so you're doing a purchase application in an area that has a lot of strong comparables, it may qualify for an AVM. You really don't see it very often anymore. So it's not super common, but it's something that the lender will mention to you. I find Equitable will do AVMs a lot, or desktop appraisals a lot because they have their own system. So it does depend on the lender. Scotiabank can do them as well. I've never done one with TD. I've done a couple with First National, but they're not super common these days. Okay, back to evaluating the application. So the way that I showed this to you guys was looking at the borrower like a three-legged stool. If you have, 3 solid legs, it's a stable application. If you have 2 solid legs, maybe a little bit less stable, so you need to go to a B lender. And if you have 3 legs that aren't great, then you're probably going to end up going private. So income, you need to evaluate whether it is verifiable, and if it is, legitimate, strong income. So if your client is employed full-time, guaranteed hours, hourly, salary, typically that's going to be verifiable in some way, whether that be through T4s, pay stubs, bank statements, or a letter of employment. So that's going to be considered strong income. Something that is less verifiable or less officially verifiable through tax documents is going to be something like stated income, where your borrower is self-employed and you're relying on 12 months business bank statements to qualify and prove the number that you've given for income. So that may be less stable of a leg. And then sometimes you have a client who has foreign income, or they don't have any verifiable income at all. So all of their work is done cash. That is going to essentially completely remove that leg from the stool, and that stool is going to fall over. And you know that immediately you are almost always going to go private. The next one, on the A side, you're going to want your high to average credit. So typically like 650 and up is going to be good enough for an A lender. Sometimes you can get away with a little bit lower for one borrower and a little bit higher for another if you have 2. Bruised credit, I would consider anybody with missed payments, collections, that sort of thing, bruised credit, even if they have, a credit score that's between 650 and 700. If they do have a history of missed payments, an A lender may not consider looking at that because they don't have a solid repayment history. And then poor credit or no credit, that's either going to be your clients had a raise in bankruptcy or consumer proposal. They have debts that are currently still in collections. They have years and years worth of missed payments, not just, through a short amount of time. And just they don't have a demonstrated solid repayment history for the lender to rely on. And then the third thing to consider is going to be your property type, condition, and location. If your property is in a great location, so it's located in an urban center, it's in good livable condition, it's not currently under renovation, you don't have tons of holes in the walls, you're not missing cabinets in your kitchen, you're not missing a toilet in your bathroom, you should be good. And then property type, this is something that we've been seeing a lot, is condos are having a harder time being financed, especially on the private side, because the resale value is a little bit lower these days. I've also seen instances where somebody does qualify for a property on the A side, and then when the insurer looks at the property, they see through the status certificate of the condo that there's been 3 special assessments in the last year and the condo reserve is low. So they would not necessarily want to lend on that property type because it's likely that there will be more and more special assessments, and the condo is just not being taken care of very well. If the property is under renovation, if it's not, 98.5% complete, that's probably not something an A lender or B lender is going to look at. You would have to go private. So you need to look at all 3 aspects of your application: the income, the credit, and the property. If all 3 are strong, you can probably go to an A lender. If, say, your property and your income are strong, but your credit's not so great, you may have to go to a B lender. And then, say your income and your credit are both not very good, but it's a good property in a good location, then most likely private is what you're going to have to consider. Sorry, it looks like there's a question here. For a lender who having a gift money or borrowing money from a friend for closing over 20% down payment, how much is the minimum time is required for funds to be in their account? So you can use borrowed funds for a down payment. Typically, if it's gifted funds, they would want that to be from a family member. So that is going to be, a direct family member, parent, or sibling. Sometimes you could get away with like an aunt or an uncle. I've also had an instance where it was somebody who wasn't directly related, but had raised the applicant. If it's gifted income that the lender will accept, you typically want them to have that money in their bank account 30 days before closing, and you would have a gift letter signed by the donor. That makes sure that you don't need any documents from the person who's gifting the funds. If those funds are in the borrower's bank account less than 30 days before, or if the gifter is depositing them directly to the lawyer, you may have to request a bank statement from the person gifting the funds. So that is something to keep in mind if, say, your client is telling you that their dad's giving them the money, but it's not coming from their dad, or you have a feeling it's not coming from their dad. Communicate those requirements to your client up front and tell them where it's going. If they're putting more than 20% down, how much is the minimum time required for funds to be in the account? If your client's down payment is coming from a source that a lender is not necessarily going to be happy with, then those funds need to be in their bank account for 90 days before closing. You need to source your client's down payment with pretty much all lenders other than private for 90 days. Some private lenders like Mix and Admins will require a 30-day history just to prove that they have the funds for the down payment. But in general, money in account for 90 days before closing, if it's coming from anything other than their own personal savings or a verifiable gift.
So is it not possible for them to obtain the money from their line of credit in order to close the transaction, just in case if they need something extra? If they are able to, because sometimes there is a client, let's say there's a client borrower who is trying to avoid that method, which is, which will save him the CMHC fees, and he can, borrow a little bit of money from his friends, and so that he can do 20% down payment, and then he don't have to go through the CMHC process. So how is that possible for him to utilize his line of credit and stuff like that?
Typically,
Can he
you
put?
cannot borrow funds from your friends for down payment. Most A lenders will not allow it. B lenders, maybe if you have a good explanation, if it's repayment of debt, if it's something like that. Private lenders probably don't care. A lenders, absolutely not. You cannot borrow money from your friends. You can only be gifted money from family members. If you borrow money from your line of credit or credit card or anything like that for down payment, it is allowed, but they need to qualify you. So if you are borrowing $50,000 from your line of credit for your down payment, they also need to add in 3% of that $50,000 into your debt service ratios to confirm that you still qualify. So if you have a client and you've submitted saying that they have $100,000 coming from savings, but it turns out they have 50,000 coming from savings and 50,000 coming from that line of credit, they're going to take 3% of $50,000, which is going to be $1,500, and add that into their TDS calculation, which may disqualify your client from that mortgage. So something, again, you need to know where that down payment is coming from that first conversation on, so you know exactly what you need to do to qualify the client.
Okay, so it doesn't matter whether you paid more than 20% or less than that.
It all depends on the lender's policies.
Okay.
A lenders, like I said, you're not going to be able to borrow income from a friend. Borrow down payment from a friend. It's just not allowed. It's all about the anti-money laundering policies. They won't allow it.
Okay.
Any other questions? Okay, let's see what I have here. Oh, go ahead.
So for the investment properties, right? So let's say if a borrower is looking to buy a house with a 20% down payment, right? And half of his, like, let's say $50,000 is coming from his line of credit, and then he's making around 2,500 rent from that property. So we can we add that income, or like full amount of that rental income, or half amount of that rental income, in order for him to qualify for the mortgage for investment property?
So, again, one, it depends on what type of lender that you're sending it to. And then it also depends on how many rental properties the client owns. So most lenders have very different policies. But as you can see here, we add the monthly rental income. Mostly it's going to be back into the gross income. So I would actually switch this. We'd be adding 50% into the gross income. Most A lenders, if you're buying one rental property or you have one rental property, it's a 50% add back into the gross income. Some B lenders will allow you 100% add back to gross income. Sometimes it's 85%, sometimes it's 75%. Some A lenders may allow you to reduce rental expenses and add back to gross income at, say, like 85%. Again, it's all based on what the lender's policy is and how many rental properties the client owns. If your client has more than 2 rental properties and an owner occupied property, typically on the A side in particular, you're going to be filling out a rental worksheet where it's going to calculate the debt service coverage, and that's going to decide whether or not they're going to lend to you. It's less based on GDS and TDS, or it's based on both.
So if the owner, if the borrower doesn't have any primary property, right, but he's living with his parents, and then he is basically investing his first home as an investment with 20% down payment, so that in that case, he doesn't have to show what do you call? So he will be qualified as, like, again, as the first time home buyer as well, right? Because he just buying his property, but his property is not his primary home; it is just his investment property. Or for somebody who is still living in, like, for example, somebody who's living in Mississauga, right? And he's buying a investment property in London area. He can move there, but he's just buying it for the sort of investment purposes.
Yeah, that's definitely allowed.
Okay.
Again, they're probably only going to include 50% of that rental income in his gross income. So that's something to keep in mind. And if he is renting a property, you have to include his rental income in the debt service ratios. Or if he's living with parents, oftentimes they will force you to include a shelter payment in your debt service ratios. So even if you say they live with parents,
I was
but they
here
don't pay
before
rent,
you. What are you doing? Yeah, but she was there and I just
Laura?
let her go. You're a fucking asshole.
Laura, could you mute yourself?
Oh, sorry.
That's okay.
I thought I was. I'm so sorry.
All good, no worries. So a lot of the time, like I said, lenders, if they're living with parents, will make you include a shelter payment. That could be anywhere from $450, $900, $1,200, depends on the location of the property. Even if they don't pay rent, sometimes they will force you to include that. And then if they are renting a property, you do need to include their full rent in the debt service ratios. So that's something to keep in mind as well.
Yeah, and but we do so before closing the property, do we need to produce a rental agreement for the property, or they will just use the market rent for the property?
You can use market rents, or if you have a lease agreement, you could show the lease agreement. They may want proof of first and last month's rent though, especially if what you're renting it for is higher than the market rents that come in on the appraisal. They may ask for the signed lease agreement and proof of deposit for first and last month's rent.
Okay. Thank you.
If you can qualify with the market rents, I would just do the market rents on the appraisal. It's easier that way.
All right.
Okay. Okay, back to evaluating the application. You do need to ensure that your client can provide the necessary documents to validate their employment, validate their rental income, validate their expenses. So that's going to be, you know, your T4s, your letter of employment, your T1 generals. For properties owned, if it's a rental property, they may want a lease agreement and proof that the T1, that the income has been claimed on the T1s. They may also look for the last 3 months bank statements to confirm the rental income. So you want to make sure that all of the information that you're submitting can be backed up by the documents that's required by the lender. Sometimes B lenders only need a lease agreement. They don't look for bank statements. They don't look for T1s. So if your client doesn't actually have a tenant in the property, but they've given you a lease agreement, you're probably not going to be able to go to the A side. You may have to go to the B side or the private side. Again, does the lender have a product that can fit the client's needs? If they're just looking for a line of credit, does this lender have a line of credit product? If they're looking for something that has no prepayment penalty, do they have an open product, or do they have a product that is variable with a limited prepayment penalty? Are they able to refinance the mortgage or port the mortgage because they only plan on staying there for a few days? Question, can Scotia and TD do the 7th property? Client has 5 rentals and 1 residential. It depends on whether or not they are single unit properties or multiple unit properties. I would say both TD and Scotia could do it, as long as your GDS and TDS in line and your rental worksheet is within their required DSC. So I would put your whole application together, see what your GDS and TDS look like, and then you can go into, I would say, the TD portal and download their rental worksheet and completely fill that out. It gives you the qualifying number on the rental worksheet. It does all the calculations for you. You just have to input the mortgage payment, the insurance payment, the property taxes, the rental income, and see how your rental worksheet looks. If everything looks good, then I would say that TD or Scotia would do it. Typically 9 is where you run into issues. I've seen Scotia do more. Rarely it happens, but 9 is normally like the max for properties in your personal name. Okay, last thing is, does our solution solve the client's problem? So if your client comes to you and they wanted a $200,000 equity takeout, is the mortgage that you are giving them, is the rate that you're giving them, is the amortization that you're giving them, is that going to solve the client's problem? So are they getting their equity takeout? Are they getting their 3-year fixed rate that's within the range that they want? Yes. Okay, perfect. So the client can provide the documents that the lender needs, the lender can provide the product that the client needs, and the client's problem is solved. Back to that question about rental properties. Both of them do a rental offset. I believe Scotia's is like 85% reduce rental expenses, add back to gross income. I don't remember 100%. I would calculate, like when you're filling out your application, I would just do 50% add to gross income. I believe that's what TD does. So again, fill out your rental worksheet from the TD portal. If you can't get that, send me a message and I can log in and send you the rental worksheet. I can just download one and email it to you. Okay, something that we've gone through already, again, things to consider when selecting your lender: the rate, the speed of the underwriting. So if you know that this lender is going to take 5 days to get back to you, but you have a 3-day financing condition, pick somebody else. How good service they give you and what their reputation is. A lot of the time when you're dealing with monoline lenders, so like First National, clients often Google First National or Home Trust and look at the reviews online if it's something that they've never heard of. Home Trust especially has a lot of bad reviews online because they used to be really, they had a rough go a while ago. I've never had a poor experience with them, so if your client ever asks, you can, give them what your experience has been working with them. You also want to consider the brokerage preference. So if your brokerage has a deal with, say, TD, that we get the best rates, but we need to fund $20 million annually with them, that's something you should be aware of to know that, okay, if we want to keep these great rates from TD, we better submit to TD. That also ties into the relationship that you have with the lender. If it's something that you deal with frequently, if you know you have a really good underwriter that will work with you quickly, give you the exceptions you need. And then the last two would be finder's fee and loyalty programs. This should be the last thing you consider is how much you're getting paid on the deal, especially consider ethical considerations. It's just important, if you can get the same rate from two different places, but you're going to get paid an extra 10, 15, 20 bips elsewhere, then go to the one that's going to pay you more, as long as you know you're going to get the same service. These are all product sheets that you can find through Lender Spotlight. If you click on, I'll show you here. If you click on the lender, typically, let's say Strive, if you click on the lender and you go to documents, you can see all of the general guidelines. All of their product sheets are going to be on Lender Spotlight. So those are good resources. It tells you their general policies here. I think, yeah, so more underwriting policies for B2B. We kind of talked about this earlier, just common exceptions that you can ask for if your GDS and TDS are out of guidelines. If the credit score is below the minimum by a few points, but you have good reasoning, say they went through a divorce or a separation, they've got good credit history in the last 2 years, they're just still recovering. Add backs for self-employed expenses or gross ups for self-employed expenses. If they have a car payment that's for their business, it comes out of their business account, but it reports on their personal credit bureau, you can try and get an exception so that they don't include that in the debt service ratios. You can get exceptions for loan to value, obviously not when it comes to the difference between conventional and insurable, but sometimes if a lender says we can only lend up to 65% in a rural area, you can try and get an exception for a higher loan to value. Again, if you have a good lender that likes you, that you have a good relationship with, they're more likely to fight for you on these exceptions. That comes back down to property location as well. And then income and required documents kind of tie together. Sometimes if you're missing a notice of assessment or you're missing a pay stub, if you can work with the lender to find solutions to show income or the required documents in other ways, goes back to having a good relationship with your BDM and a good relationship with your underwriter. Okay, that's it for today.